I'm Getchin Share with HomesNet Realty, and I thank you for watching. And if this is your first time on this channel, please consider subscribing and click on the bell to be notified when I post new videos. In this episode of Let's Talk Real Estate, I will go over 20 questions, multiple choice questions, designed to help you pass the Florida real estate exam. Let's get right into it. Part 13, Types of Mortgages and Sources of Financing, 4%. Part 12, we discuss mortgages in general, but here we're going to discuss the different types of mortgages and where the money comes from, in essence. Number one, the process of qualifying a borrower and a property in connection with a loan application is known as a mortgage underwriting. Now, mortgage underwriting is when it's a process that the lender or the bank goes through to assess the risks that are involved with that particular transaction. In doing so, they'll evaluate the borrower, they'll evaluate the borrower's ability to pay and desire to pay. So they'll check their source of income as well as their credit report. And the lender will also qualify the property, because remember, the borrower is using the property as collateral. So the lender, or the bank, if you would, the bank would want to make sure that the property has enough value that is comparable to the loan amount they're making. Number two, our loan applicants' past credit history indicate they're blank to honor the debt obligation, and their income is a measure of the blank to repay the loan. Well, I just basically told you just that. The lender uses a person's credit history, their credit report, to determine the person's willingness to pay their debt. And yet, the lender will also evaluate the person's income to determine or to evaluate if the person has the ability to repay the loan. That is pretty simple. Number three, life insurance companies are the largest source of funds for blank loans. Well, that would be non-residential loans. Life insurance companies have a lot of predictable funds, and they have a whole lot of money, and they need to invest that money to keep it growing. So they have available funds to pay off their policies. Number four, the primary mortgage market is where loans are blank. Well, that's where loans are originated, or that's where loans are made. The primary mortgage market is where the loan is originated. Number five, the Federal Reserve System's least effective tools to affect the money supplies is the ability to change the blank. Well, that is their ability to change the discount rates. Discount rate is what the Federal Reserve loaned the money to the 12 regional banks at a discounted rate, and the 12 regional bank loan the money further down until it gets to the consumers. So what this is saying is that is the least effective tools of the tools that the Federal Reserve System has at its disposal. Number six, mortgage loan originators, also known as MLOs, blank loans, and mortgage lenders blank loans. Well, very simple. The mortgage loan originator is the individual who arranged for the loans, and the lender makes the loan. Number 7, the Federal Reserve System's most effective tool to affect the money supply is referred to as the blank. Well, that would be the open market operations. In other words, the market works best when it's operating openly without any influence. So that is the best tool. Number 8, the flow of funds into deposits held by primary lenders that increase the mortgage money supply is referred to as blank. That is intermediation. Intermediation is when there is an input of money, an increase of money into the money supply. Well, when that happens, when you have a lot of money into the economy, when you add like we had in 2021, you have the government putting a lot of money into the money supply. So therefore, that has one impact. Money is cheap. So when you have a surplus of anything, well, the cost of that something would go down. So that's why interest rate went so low, because the government put so much money into the money supply. That's called intermediation. Intermediation, that is putting money into the money supply. Number 9, if the Federal Reserve should decide to buy government securities, the money supply would blank and interest would blank. If the government decides to buy government securities, well, money supply would increase and the rate would decrease, interest rate would decrease. So in other words, more money into the economy, interest will go down. Number 10, the secondary mortgage market provides blank to the primary mortgage market. Well, that term is referred to as liquidity. Well, the secondary, we've already discussed the primary. The primary is where the money is made, whereas the secondary is where those mortgages are purchased. That's where they're bought. So because the secondary market buys existing loans, and investors buy existing loans in the secondary market, then it provides more money for the primary market to make more loan. So that is the concept behind it. Let me take a moment to say thank you for supporting. And if you have not subscribed, it's very simple. Just hover over that picture at the bottom of your screen and click subscribe, and you can check the bell to be notified when I post new videos. Number 11, on a closing statement, how would a purchase money second mortgage obtained from the seller be entered? So here they're telling you a seller who is giving a loan to a purchaser. So here you can see the key words: how purchase money obtained from the seller entered into the closing statement. Well, the closing statement is just a summary of the transaction. You have to account for every penny that's spent in the transaction. So that is the closing statement. Well, it would be entered as a credit to the buyer and a debit to the seller, because if I'm selling my house, let's say for $500,000, and a person pays me $250,000, well, I'm holding the mortgage for them. So that is something I'm entitled to the full 500. So he will get, or he or she will get, a credit for the 250 that I'm holding. So that's what you call seller financing. Number 12, which would be a consideration in underwriting an FHA loan application, but not considered for a VA loan. Well, if you read the material, you should understand where this is going. An FHA requires insurance. FHA insures the loan, whereas the VA, the Veterans Affairs, guarantees the loan. So in that case, if a lender is evaluating or underwriting an FHA loan, they'll have to take into account the cost of insurance, mortgage insurance. Whereas for a VA, the VA guarantees the loan, so or guaranteed part 25% of the loan, not the whole thing. Now keep in mind, most of these stuff I'm discussing here, I have videos explaining every single one of them. I suggest you watch some of them, everything dealing from FHA, VA, and conventional loan. And I think I even have a video about USDA loans. So if you want to learn more about that after you've passed your exam, make sure you check those out as well. Okay. Number 13, with which type of mortgage could negative amortization occur due to payment caps? Well, that would be an adjustable rate mortgage. Well, when interest rates start creeping up, banks usually offer what's called adjustable rate mortgage. The early years, most of the payment goes towards interest. Well, if it's adjustable, there might be a potential where the interest could go higher and the bulk of the money that's paying on a monthly basis goes towards the interest only and not paying back any of the principal of the loan. If you understand amortization, that is when you are killing the loan. The payment you're making is sufficient to pay both the interest on the loan and pay down some of the principal. So when if a person's payment is insufficient to pay down both the principal and the interest, well, the interest will continue, and the possibility that the mortgage loan balance may be higher than where we started from. Okay, so it may be higher than so every month the person could add more interest to the loan balance because their payment is insufficient to cover the full amount. Number 14, when does disintermediation occur? Disintermediation occurs when you withdraw funds from the money supply. So you can see here, when withdrawals exceed deposits, then you have disintermediation, because banks make loans with deposits. I make a deposit, we all make a deposit. Well, someone down the street wants to buy a home, the bank has enough resources to make a loan to that person as an interest, and hopefully they'll share some of that with us. Good luck. But when we talk about withdrawals, so if everybody withdraw their money, if the withdrawals from the bank is greater than the money that's going in, so the bank will not have sufficient funds to make that loan to the person down the street. Number 15, what is the function of Fannie Mae? Well, Fannie Mae is the body or the entity that creates guidelines. So their purpose, their function is to regulate lending terms and policies for banks that are a member of their association. So Fannie Mae, main purpose. So you probably heard of Fannie Mae guidelines. Well, they set the guidelines. And when they set the guidelines, because Fannie Mae does buy government-backed mortgage loans, but they set certain criteria, certain guidelines, certain parameters. So they're the one that regulates that. Number 16, how is the interest rate determined on an FHA insured mortgage loan? Well, that's very simple. The market, just keep in mind, we are in a capitalistic system. So the market controls. Now, while the government may increase their discount rate, but the market dictates supply and demand. Very simple. Supply and demand. You have the money, but you have more money than you have demand, interest rate will be low. You have less money, a higher demand, interest rate will increase. Number 17, which type of mortgage typically requires a higher down payment and interest rate than other common loan types? Well, that would be your conventional loan, because conventional loans, unlike the FHA that is insured by the government will insure that, and the VA where it's guaranteed, conventional loans are not. So there tend to be higher interest rates. You don't want to put, in my insurance, you would have to put 20% down. But if anything less than 20% down, the lender would want you to have some kind of insurance to protect their interests. Number 18, which of the following applies to the FHA Section 203B loan program? Well, that is your typical FHA loan, or also referred to as 203B. Now, this is simply saying this is a law. The FHA, the section of the law 203, well, what it does, it allows people to buy using the FHA insured mortgage program. And if it's a single family, 2-unit, 3-unit, 4 units, you can do that as long as you occupy one of the units. Number 19, which statement is correct regarding the FHA loan program? Well, the FHA loan program, we know the FHA insures loan. It does not guarantee. VA guarantees, FHA insures. Pretty simple. Number 20, a mortgagor who purchases under the FHA 203B mortgage loan program may have monthly payments that include principal and what else? Well, in the industry, we refer to it as PITI. PITI means when you make your monthly mortgage loan payment, it includes the principal, that is to kill the loan. It includes the interest, that is the cost of the loan, but it also includes taxes, property taxes. It includes any insurances that you may have. If you are required to have MI insurance, which is mortgage insurance, you got to pay that. If you need to pay property insurance, you have to provide that. So the bank wants to make sure all that money goes all in one. That's part of the payment, because you can see a scenario where if that's not the case, a person would probably not pay taxes, although they're paying the mortgage and not paying their taxes. Well, that would still be a liability for the lender, and the lender wants to ensure that their interest is protected. So PD means principal, interest, taxes, and insurance. Everything is included in your mortgage payment. Thank you for watching. Please don't forget to subscribe, share, comment, and like. And I thank you for watching. And as always, have a blessed and productive day. Thank you.